Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at Applied Digital.
If you find our talks useful, please consider subscribe, like, and comment underneath. But let's step away from the housekeeping for a second because I really want to give you a scenario.
Okay, let's hear it.
Imagine you finally save up enough capital to buy a money printing factory. You know it works. You know there's endless demand for the product. But on day one, your accountant looks at the books and insists you are technically bankrupt.
Right, that is quite the paradox.
Exactly. It's this massive paradox, a wildly successful underlying asset masked by a catastrophic on-paper loss. And that is exactly what we are unpacking today. We are looking at a masterclass in aggressive corporate evolution.
Yeah, it really is.
So if you are actively building your portfolio and hunting for those, high conviction entry points into the AI supercycle, this is a real-time case study you absolutely need to understand.
I completely agree, because Applied Digital represents one of the most difficult things a company can do, which is a complete successful pivot.
Yeah.
They looked at the landscape a few years ago and realized the long-term limitations of their original business model, which, was crypto mining.
Right. Crypto.
Yeah, and they pivoted entirely to high-performance AI data center hosting.
Yeah.
And, that is not just a matter of changing the logo on the building.
No, definitely not.
It requires a complete reimagining of the physical infrastructure, massive capital reallocation, and basically acquiring an entirely new class of enterprise customers.
And that aggressive pivot is what brings us to the immediate catalyst that put them on our radar, which is their latest Q3 2026 earnings report.
Yeah, that report is fascinating.
I really want to look past the surface level noise today, because if you just glance at the headlines of this earnings release, it looks, well, incredibly confusing.
It really does.
Yeah, this undeniable, explosive revenue growth crashing headfirst into a massive GAAP net loss. I'm looking at this hyper-growth trajectory, but I want to get the specific breakdown from you. Just how thoroughly did they beat Wall Street's expectations on the top line?
Oh, they absolutely obliterated them. Total revenue for the quarter hit $126.6 million.
Wow.
Yeah. To put that in context, that is a 139% year-over-year jump.
Yeah.
The broader market consensus, what the institutional analysts had modeled for them to bring in, was only $76.56 million.
Wait, so they beat expectations by nearly $50 million.
Exactly.
139% increase is just wild. Where is that surge actually coming from? Is it the new data center segment pulling all that weight?
Yes, it is. The data center hosting segment, which is really the core of their new identity, generated $37.5 million in revenue on its own.
Right.
And honestly, more importantly, it brought in $13.9 million in operating profit. That operating profit metric is critical.
Why is that the critical part?
Because it proves the concept. It shows that hosting these massive AI operations has tremendous operational leverage. The core engine is highly profitable.
But see, this is where I have to step in and ask the hard questions on behalf of the listener.
Go for it.
Because if I pull up their financial statement right now, the very first thing I see is a GAAP net loss of $100.9 million.
Right, the GAAP loss.
Yeah. How do you smash revenue estimates by $50 million, prove your core engine is profitable, and still lose $100 million on paper?
It sounds impossible, I know.
Let me offer an analogy to see if I'm grasping this. It feels like buying an outdated commercial property to turn it into luxury condos.
Okay, I like where this is going.
The first thing you do is gut the building. You rip out the old plumbing, the old wiring, you knock down walls. For that first year, your accountant files your taxes and says you took a massive loss because you spent a fortune on renovations and effectively destroyed the value of the old asset.
Yeah.
But you aren't actually failing, right?
Yep.
You are intentionally taking a hit to clear the way for a highly lucrative structure. Is that what we are seeing in this earnings report?
The real estate analogy works perfectly for understanding the impairment, but it actually falls a bit short of capturing the sheer scale of the debt, which we will get to in a moment.
Okay, fair enough.
But regarding that $100 million loss, you are exactly right. That GAAP net loss is heavily skewed by a $59.7 million cloud impairment.
Okay, wait, an impairment? What does that actually mean in plain English for someone just trying to read this balance sheet?
It basically means they wrote down the value of an asset. In this case, it's a non-cash accounting charge related to their legacy cloud business.
Non-cash, meaning no actual money was lost.
Exactly. This is crucial to understand. An impairment is a rear-view mirror metric. It does not mean $59.7 million in physical cash walked out the door this quarter.
Right.
It simply means they are adjusting their ledger to reflect the reality that their old assets aren't worth what they used to be now that they're entirely focused on this new AI infrastructure.
Ah, okay. So the accountants are forcing them to reconcile the past,
Hmm.
which makes the present look way worse than it is.
Exactly.
So what happens when you strip away that accounting noise?
When you remove those one-time non-cash distractions, the financial reality shifts dramatically. Their adjusted earnings per share was actually positive 9 cents.
Wait, positive. I thought the street was expecting a loss.
They were. The street was expecting a loss of 10 cents per share, so realistically, it was a massive beat on both the top and bottom lines.
That is a huge swing.
It is. And their forward projections are pointing to $145 million in Q3 revenue, which is supported by new enterprise AI partnerships in healthcare and finance.
All right, so we've established that the underlying data center business is a cash-generating engine. But if this is so lucrative, we have to talk about moats.
Right, the defensive moat.
Everyone listening to this knows AI is the future. Everyone knows AI needs massive data centers to run. So why can't a competitor just raise some venture capital, buy an empty warehouse, and eat Applied Digital's lunch?
That is the big question.
What makes their specific infrastructure an undeniable moat?
It comes down to the physical constraints of the AI supercycle. Most people focus on the processing chips, the GPUs designed by the big tech companies.
Right, everyone talks about the chips.
But getting the chips is only half the battle. The real bottlenecks in the AI race are infrastructure velocity, specialized liquid cooling technology, and above all else, access to raw, uninterrupted power.
Let's dig into that cooling aspect first, because I think a lot of people assume a server farm is just a server farm.
Yeah, they do.
Why do these AI data centers specifically need liquid cooling? Why can't they just use giant air conditioners like the tech industry has done for the last 20 years?
It is entirely a matter of sheer thermal physics. The newest AI processors draw a staggering amount of wattage.
Yep.
When you pull that much electricity into a small piece of silicon, the byproduct is immense heat. Traditional data centers basically act like giant refrigerators. They push massive amounts of freezing cold air down the aisle.
That classic hum of a server room.
Exactly. But air is actually a terrible conductor of heat. These new chips run so hot that traditional air conditioning literally cannot cool them fast enough.
Oh, wow, really?
Yeah, if you put an AI cluster in a traditional facility, the chips will overheat and thermally throttle themselves, meaning they intentionally slow down to prevent a fire.
Well, that entirely defeats the purpose of buying million-dollar ultra-fast chips.
Exactly. You have to pump liquid directly to the chip to absorb that heat. And retrofitting an old legacy data center with massive plumbing networks for liquid cooling is incredibly difficult and expensive.
So starting from scratch is actually an advantage.
Huge advantage. Applied Digital building purpose-built liquid-cooled facilities from the ground up is a massive structural advantage.
That makes perfect sense. You can't just plug a supercomputer into a wall fan. But let's talk about the actual electricity, because you mentioned raw power is the ultimate bottleneck. What does Applied Digital's physical footprint look like right now in terms of power?
Right now, they have 600 megawatts of power currently under contract.
600 megawatts. How much is that, practically speaking?
To put that in perspective, a single megawatt can power hundreds of homes, so it's massive. They also have a full gigawatt of capacity currently under construction.
A gigawatt.
Yes, which includes a massive 300 megawatt facility called Delta Forge 1, expected to come online by mid-2027. And they are in advanced discussions to expand by another 1.5 gigawatts.
But again, I have to ask, why is getting a gigawatt of power so difficult? Why can't a rival tech company just call up their local utility provider and say, hey, we are building a big facility, send us a gigawatt?
Because the U.S. electrical grid is effectively maxed out in many regions, and it is built on aging infrastructure. A gigawatt of power is enough to run a medium-sized city.
Oh, wow.
You don't just flip a switch for that. The utility company has to build entirely new, high-voltage transmission lines. They have to build dedicated electrical substations.
And I imagine that takes time.
A lot of time. The supply chain for that heavy equipment is heavily backlogged. If you want to order a massive step-down transformer for a new substation right now, the wait time is often 2 to 3 years.
2 to 3 years just for the equipment.
Just to get it delivered,
Right.
let alone navigating the environmental permitting, municipal zoning, and the actual construction.
Okay, so it's a massive structural roadblock. Applied Digital essentially bypassed the multi-year waiting line by securing this power early.
Exactly. They secured this power capacity before the AI boom truly strained the grid to its breaking point.
That's incredibly forward-thinking.
It really is. And here's where it translates directly into long-term value for a portfolio. They aren't just sitting on this electricity. They have signed $16 billion in contracted lease revenues, locked in over the next 15 years with investment-grade hyperscalers.
So they aren't mining the gold themselves. They own the only river in town where you can pan for gold, and they've locked the biggest tech giants into 15-year leases just to access the water.
That is exactly it. Having $16 billion locked in over 15 years gives them a level of revenue visibility that is almost unheard of in the tech sector.
Okay, I love the revenue visibility, but building that river access is not cheap.
No, it isn't.
Securing gigawatts of power and outfitting facilities with miles of liquid cooling plumbing requires a staggering amount of capital,
Well,
which brings us to the balance sheet.
right.
And honestly, this is the part of the analysis that makes me sweat on behalf of the listener.
Mm.
If I am looking at my brokerage account and I see a company with $2.7 billion in debt
Yeah, that's a big number.
and $2.1 billion in cash and a history of burning hundreds of millions of dollars in negative free cash flow because of these construction costs, I mean, my instinct is to panic sell.
I get that.
Why shouldn't the listener do exactly that right now? This sounds like a dilution time bomb. How does this not end with them issuing a mountain of new shares just to keep the lights on?
It is a totally valid concern, and I'm really glad you brought it up. If you were looking at a traditional software company with that kind of cash burn, you would be absolutely right to run for the exits.
Okay, so what makes this different?
We have to fundamentally reframe how we assess debt when we are talking about massive hard asset infrastructure. Look at how they are borrowing this money.
How so?
They recently executed a $2.15 billion senior secured note offering.
Okay, let's pause and unpack that, because senior secured note sounds like Wall Street jargon meant to sound safe. What does that actually mean mechanically for the company?
It is a specific type of institutional debt. Senior means that in the absolute worst case scenario, like if the company were to go bankrupt, these lenders are first in line to get paid back before anyone else.
And what about the secured part?
Secured means the loan isn't just based on good faith. There is actual hard collateral backing it up. Institutional lenders at this level do not hand over $2.15 billion based on optimistic PowerPoint presentations.
I would hope not.
No, they run exhaustive granular risk models. The reason they were willing to hand over billions in debt is because that debt is secured against the $16 billion contracted backlog we just talked about.
Ah, okay. So the institutional lenders know the facilities are going to print money for the next 15 years because the leases are already signed by bulletproof tech giants.
Precisely.
So lenders are more than happy to front the cash to pour the concrete today.
Exactly. In the infrastructure world, securing your capital before the massive build-out is actually a huge signal of institutional credit confidence.
That completely flips the perspective.
Right. And that $2.1 billion in cash they have sitting on the balance sheet, that provides the crucial runway. It ensures they have the pure liquidity required to finish construction on projects like Delta Forge 1 without needing to come back to the equity markets tomorrow and dilute your shares.
So it's just part of the normal cycle for this type of business.
Yes. The cycle goes. Heavy capital expenditure first, cash flow turns negative as you build, the infrastructure gets finished, and then the 15-year revenue tap turns on.
Okay, so if the fundamental growth is there, the physical moat of secured power is real, and the debt structure actually signals institutional confidence, why has the stock's recent price action been absolute schizophrenia?
Yeah, it's been rough.
If I look at the chart, it makes no sense.
The volatility has been intense, to put it mildly. Wall Street is having a very hard time pricing in the transition from construction phase to operational phase.
Let's walk through the timeline because it's a perfect example of market confusion.
Yeah.
On April 8th, shares surged 12.3% intraday, catching a ride on a broader tech sector rebound. Then they released this earnings report with a massive $50 million revenue beat, and the stock soars even higher in after-hours trading.
Exactly as it should.
But then, the very next morning, April 9th, the market opens and shares fall sharply in pre-market trading. It completely ignored the strong fundamentals we just outlined.
Yep, completely ignore them.
If you're an investor, seeing your stock drop 15% pre-market after a massive earnings beat is terrifying.
It is a classic sell the news consolidation, and it creates what we call a whipsaw effect. The market action jerks rapidly in one direction and then violently snaps back in the other.
But a whipsaw like that is usually driven by a specific type of market participant, right?
Exactly.
It shakes out the tourist investors, the retail traders who only read the Gap headline. They see a $100 million loss on a stock screener and they immediately hit the sell button.
Yeah, without taking the time to understand the mechanics of a non-cash cloud impairment or the operational leverage of a 15-year lease.
So they just panic.
That is exactly what happens. But while retail investors might panic sell the headline, institutional analysts are looking straight through the noise.
Oh, really?
Oh, yeah. Despite that pre-market drop, analyst conviction remains incredibly high. Citizens came out and reiterated a market outperform rating with a $40 price target.
Wow, $40.
Yeah, and Needham raised their target to $20. They are ignoring the daily whipsaw and focusing squarely on the execution of that $16 billion backlog.
We also have to acknowledge the macro environment here, because that April 8th tech surge didn't happen in a vacuum.
That's true.
I read that a lot of that broader market movement was tied to a ceasefire consensus forming between the U.S. and Iran, which brings up an interesting question.
Okay.
How does a geopolitical ceasefire in the Middle East directly impact the gross margins of an AI data center stock in the United States?
It seems totally disconnected, but if you map the causal chain, it makes perfect sense.
Okay, walk us through it.
Geopolitical tension in the Middle East immediately threatens the global supply of crude oil. When oil supplies are threatened, prices spike.
Right, we've all seen that at the gas pump.
Exactly.
Right.
And when crude oil spikes, the cost of natural gas and other alternative energy sources usually rises in tandem as global energy markets adjust.
And natural gas is what powers a massive percentage of the U.S. electrical grid.
Precisely. So when geopolitical de-escalation happens, anxieties in the energy markets ease. The threat of an oil shock drops and utility costs stabilize.
Ah, I see.
For a company like Applied Digital, whose entire business model requires consuming gigawatts of electricity around the clock, stable energy costs are a massive macro tailwind.
Because it drops their overhead.
Exactly. It drastically improves their operational bottom line and makes those 15-year fixed contracts even more lucrative. So the macro environment of global energy and the micro environment of their specific data centers are deeply intertwined.
So given all this, the past performance, the whipsaw market chaos, the energy mechanics, what are the hard catalysts the listener needs to be watching for over the next 6 to 12 months?
Yeah.
What actually triggers that run-up to the $40 price target?
Keep your radar highly tuned for 3 specific things.
Okay, what's first?
First, announcements of new hyperscaler tenants. We know they are in advanced discussions to expand their capacity by 1.5 gigawatts. The moment they announce a finalized signed contract for that new capacity, Wall Street will be forced to aggressively re-rate their future earnings.
Okay, finalized tenant contracts. What is the second catalyst?
Second is the structural evolution of their cloud business. They recently separated it into a focused infrastructure platform. There is significant potential to unlock shareholder value there.
How so?
That could happen mechanically through a complete spin-off into a new publicly traded entity, an outright asset sale, or a strategic joint venture with a larger tech player. Either way, it invests capital.
Makes sense. And the third?
Watch the Federal Reserve. Any concrete action or commentary on rate cuts is disproportionately beneficial for high capex, infrastructure-heavy companies.
Because cheaper borrowing costs mean that $2.7 billion debt load becomes much cheaper to service, right? Freeing up more free cash flow.
Precisely.
But I want to be entirely balanced here. What is the bear case? What are the specific mechanisms that could derail this thesis and destroy value for the listener?
The primary threat is pure execution risk on that $2.7 billion capital deployment.
Right. Actually building the things.
Yeah. Building a gigawatt of liquid-cooled data centers requires incredibly complex, massive-scale engineering. If there is a significant delay in the construction of Delta Forge 1, whether due to supply chain issues with those transformers we mentioned or labor shortages, it delays the moment they can turn on those 15-year leases.
And that would heavily strain their balance sheet, wouldn't it?
Exactly, because they would continue to burn cash without the offsetting revenue.
It's basically a race against the clock to finish the facilities before the cash runway ends.
Exactly. The other risk is valuation. The stock currently commands a premium valuation, with a market cap sitting around $7.65 billion.
Okay.
Combine that premium valuation with the fact that their gross margins recently saw a slight decline to 13%, and you have a stock that is priced for near perfection.
So any slip-up is punished heavily.
Right. If the broader AI supercycle narrative cools down, or if the major tech giants suddenly pull back on their infrastructure spending, Applied Digital could face a severe derating by the market.
So bringing all the mechanisms, the risks, and the catalysts together, what is the final score for the portfolio?
Based on the structural advantages, we are giving this an 8 out of 10 bullish rating.
An 8 out of 10.
Yes. However, it is explicitly categorized as a medium-term hold, meaning a 6 to 12-month horizon minimum.
I think that makes total sense. You
Yep.
have a company that executed one of the hardest maneuvers in business, which is pivoting perfectly into the most lucrative sector of the decade.
Yeah, they really did.
They're sitting on $16 billion in contracted, highly visible revenue. They have physically secured the electrical power required to run the AI revolution, bypassing the ultimate grid bottleneck.
Exactly.
Institutional lenders are heavily backing them, and top-tier analysts are setting a $40 price target. And all of this is happening while the retail market gets momentarily shaken out by a surface-level GAAP accounting loss.
That is the core thesis. But as you highlighted with the execution risk, this play requires genuine patience.
Right.
You have to be willing to hold your position through the short-term whipsaw noise. You have to wait for the heavy construction phase to finish so that Delta Forge 1 actually comes online, allowing the massive operational revenue to catch up to that $7.65 billion valuation.
It really is about having the conviction to let the infrastructure get built so the river access can finally open. Thank you for walking us through the mechanics of this today.
My pleasure.
And to you listening, thank you for joining today's wealth building analysis. Remember, short-term gap noise often obscures long-term infrastructure dominance.
And understanding the mechanical difference between a failing business and an expanding infrastructure moat is how you build real generational wealth.
Before we go, I want to leave you with a lingering thought as you look at your portfolio allocations this week. We spend so much time talking about the software companies. The ones designing the smartest AI brains, the next incredible language models, the most efficient code.
Yeah, that's what gets all the headlines.
Exactly. But as the physical electrical grid gets stretched to its absolute limit, ask yourself, over the next decade, who really holds the ultimate leverage? Is it the companies creating the digital intelligence? Or is it the landlords who control the physical electricity required to keep those brains alive?